Close your eyes for a moment. You work, you save. You deposit your money into a bank account with the implicit understanding that those digits on your screen represent your wealth, your effort, your future. You believe your money is an asset. But what if I told you the simple act of depositing a single dollar triggers a banking loophole that instantly transforms your most prized possession into a liability for the financial system, and by extension, for you? This is not a conspiracy theory. This is a fundamental century-old truth embedded in the DNA of modern banking that the English-speaking world, built on the gospel of banking stability, is programmed to ignore. The question you must answer right now is simple. Are you truly a saver, or are you an unwitting participant in a financial chain reaction that makes every single dollar you hold a promise of future risk? If you've ever felt like you're doing everything right, saving diligently, paying your taxes, yet the system is constantly working against you, eroding your buying power, and making the climb to real wealth impossible, you're about to discover the mechanism that proves your gut feeling is absolutely correct. To understand the dollar's vulnerability, we must first understand the fundamental lie of modern money. When you look at your checking account balance, 10,000, 50,000, whatever the number, you see an asset. When the bank looks at that same number, it sees a liability. This is the core semantic and legal trick that underpins our entire financial reality. A bank's business model is not to store your money, it is to use your money. The moment you hand over your dollar, the bank gains ownership of the cash and records your deposit as an IOU, a debt it owes you. That deposit becomes the fuel for a process known as fractional reserve banking, a loophole that allows a bank to create new money, not from gold or production, but from your trust. They take your liability, leverage it, multiply it, and then loan it out, demanding interest in the process. This isn't just modern-day Wall Street trickery, it's the culmination of 2,000 years of systemic financial abuse. A playbook written by empires long dead, but whose lessons were perfectly studied by the founders of the global dollar system. The English-speaking financial tradition, particularly in the United States and the United Kingdom, often praises stability and prudence. Yet the foundations of this system were built on the very mechanisms of currency debasement and debt creation that destroyed earlier powers. Take a journey back to the glory days of the Roman Empire, the originator of the world's first great reserve currency, the silver denarius. For centuries, the denarius was the anchor of trade, trusted across continents. But as the empire's military and political spending swelled, expenses that the government refused to cover through honest taxation, emperors turned to a silent tax, currency debasement. They slowly but systematically reduced the silver content of the coin, replacing it with cheaper metals like copper. The physical coin remained, but its value became a fiction. It was the original liability trick. The government was essentially saying, we promise this coin is still worth what it was yesterday, while knowingly robbing the population of their savings. This is the historical template for your modern dollar, a currency whose backing is constantly being diluted to fund government expenses. The pattern repeated itself violently with the advent of large-scale geopolitical conflict, a context extremely familiar to the English-speaking world. The First World War, an event often described in terms of trenches and artillery, was, in reality, a devastating financial war. Before 1914, currencies across Europe, including the British pound, were anchored to the gold standard. This metal anchor limited a government's ability to borrow and spend recklessly. But the cost of total war was astronomical, burning through gold reserves faster than anyone could imagine. One by one, the major powers, including the United Kingdom, quietly abandoned the gold standard. They admitted to their citizens that the new money was now nothing more than a promise backed by faith in the state. That moment, the shattering of the gold anchor, was the definitive shift in financial power. Money and national financing were no longer shackled by metal. They were driven by printing presses, credit, and the persuasion of propaganda. The lesson absorbed by the emerging financial superpower, the United States, was chillingly simple. To wage total war, to fund global ambition, and to prevent the social collapse caused by excessive debt, the system must be flexible, which is to say, it must be untethered. The old empires fell because they could not print their way out of their obligations fast enough. The new system, anchored by the US dollar, learned from that failure. It was designed to create an infinite supply of liabilities based on a finite resource, the public's trust. Your dollar's status as a liability, not an asset, is the direct, logical evolution of the ancient Roman debasement and the wartime abandonment of the gold standard, perfected for the modern age of digital banking. This is where the story of the banking loophole truly begins, in the subtle, legal reclassification of your savings from asset to bank liability. The core mechanism of the dollar's transformation into a liability is a masterpiece of financial engineering, fractional reserve banking. This is the loophole the title references, and it is perfectly legal, forming the bedrock of the entire global monetary supply. Here is how the trick works, connecting directly to your everyday banking experience. You deposit $10,000 into your bank. As established, the bank records this $10,000 as its liability to you. But the system does not require the bank to hold all or even most of that money. Thanks to the fractional reserve system historically, the bank only had to keep a fraction, say 10%, of your deposit on hand. Today, formal reserve requirements are often set at zero, making the leverage potential effectively infinite, relying on capital ratios instead of simple reserves, a distinction that is even more dangerous. The bank takes the $9,000 it didn't have to keep and loans it out to another customer, a small business, a homeowner, or a car buyer. The borrower receives that $9,000, typically by having it deposited into their bank account. Now, something profound has happened. The first bank still owes you $10,000. But the financial system has created an additional $9,000 of new money out of thin air, backed only by the promise of the loan being repaid. That second bank, receiving the $9,000 deposit, also treats it as a liability and can repeat the process, lending out a fraction of that amount. This is the fractional engine in action. A single initial deposit of $10,000 can eventually be leveraged into perhaps $90,000 or more in new loans and deposits across the banking system. This money multiplier effect is celebrated by economists as liquidity and economic growth. But for the saver, it is the systematic multiplication of risk. Every new dollar created in this loop is essentially a new liability for the banking system. It's a claim against a financial reality that is, by definition, leveraged beyond its immediate capacity to pay. The entire English-speaking financial universe operates on the assumption that you and the majority of other depositors will never demand your money back simultaneously. This assumption is the air the banking system breathes. If for any reason enough customers lose confidence and rush to withdraw their actual physical cash, a bank run, the system instantly seizes up, proving that the collective liability it created is far greater than the collective assets it holds. This fragility is not a design flaw, it is the design. The system is structurally reliant on your collective ignorance or collective trust, whichever fails first. The true moment this fractional engine was supercharged, guaranteeing the modern dollar's liability status, was the infamous 1971 Nixon Shock. For decades after World War II, the global economy was governed by the Bretton Woods system, which, though imperfect, pegged the US dollar to gold at a fixed rate, and other major world currencies were pegged to the dollar. This created a final thin membrane of real-world value. However, the costs of the Vietnam War and massive domestic spending pushed the US government to print far more dollars than it held in gold. When foreign nations, primarily Britain and France, began demanding gold in exchange for their dollars, the fiction was exposed. President Richard Nixon, facing the imminent depletion of US gold reserves, unilaterally announced that the dollar would no longer be convertible to gold. This was the ultimate financial move, the final severing of the dollar from any physical, tangible anchor. The dollar was transformed from a partially backed currency into a pure fiat currency, a mere paper promise, or more accurately today, a digital ledger entry. This was the moment the US adopted the Roman debasement model in its most absolute form. Only now there was no silver content to reduce. The reduction was of its entire foundation. The fractional engine, once constrained by a gold reserve requirement, was now completely untethered, allowing for the exponential expansion of liabilities across the global economy. This is the context that defines your financial life today. When a banking system exponentially expands its liabilities through fractional reserve mechanics and detaches its currency from any real value anchor, the consequences are always the same: systemic crises and the silent transfer of wealth from the many to the few. The US economic history of the last 50 years is a perfect illustration of this pattern. The 2008 financial crisis serves as the most potent recent example of the liability loophole coming full circle. It was a crisis of leveraged liability. Banks took deposits, liabilities, leveraged them to create mortgage-backed securities, complex liabilities, and then insured them with derivatives, even more complex liabilities. The entire structure became a towering pyramid of promises built on top of a single base of home loans. When the base cracked, the whole system was exposed. The response of the American political and financial establishment, the massive bailouts and quantitative easing programs, was not designed to protect the average saver. It was designed to protect the system of liabilities. They could not allow the banks to fail because their failure would reveal the devastating truth. The total liabilities created by the fractional engine were so enormous that a sovereign nation could not possibly absorb the loss. The government, through the Federal Reserve, had to become the lender of last resort, essentially creating trillions of new dollars out of thin air to cover the bank's bad promises, thereby transferring the loss from the bank's balance sheets to the public's buying power. This is the end game of the dollar as liability loophole: inflation. Inflation is simply the consequence of the system being forced to cover its accumulated liabilities. When the fractional engine creates too many claims, liabilities, dollars, chasing a finite amount of real goods and services, the value of each individual claim must decline. Inflation is the silent, pervasive tax that makes the average person pay for the fractional reserve expansion and the government's refusal to finance its own ambitions through honest means. Every time the Federal Reserve intervenes, every time a bank is bailed out, every time the government runs a deficit, your liability, the dollar in your bank account, is further diluted. History is merciless on this point. Whether it was the Roman Denarius, the German mark after World War I, or the modern American dollar, no system has escaped a reckoning when it systematically chooses financial manipulation over fiscal reality. The ultimate fate of a currency detached from value is not a sudden, dramatic event, but a slow, gradual loss of confidence that accelerates when you least expect it. The survivors of these historical collapses, from the Byzantine Empire's gold debasement to the hyperinflation of the 20th century, were not those who trusted their government's promises the most. They were the ones who doubted first. The way out of this systemic liability trap is not political, it is personal. Financial freedom means minimizing your dependency on a leveraged system. Real wealth is not found in the paper or digital digits that the fractional engine can endlessly multiply. Real wealth is found in assets that cannot be debased, tangible, productive assets like land, commodities, or businesses that generate real value, which governments and central banks cannot simply print more of. Skills and production. Those who can produce essential goods or services, the baker, the farmer, the artisan, retain value and command power when the money itself becomes meaningless. Knowledge. The awareness that systems exist to protect themselves, not you, and that the illusion of permanence is the most dangerous financial error of all. The banking loophole that makes every dollar a liability is the defining financial reality of our time. It is a system built on leveraged risk and maintained by collective trust. Understanding this truth is not a step towards cynicism. It is the essential first step toward true financial self-sovereignty. The system will continue to repeat the same ancient tricks, dressed in new language and technology. The only question that matters is whether you will be an ignorant victim of the cycle or an informed builder of real, lasting wealth. The choice is yours.